Hello, this is Mary Bourque with Glovista Investments with some comments on the European integrated oils, a sector we find attractive within the global energy space based on an investment time horizon that extends through the second half of this year. Now, in terms of the macro backdrop, although Saudi Arabia's recent surprise production cut is supportive for the crude markets, global oil demand uncertainties could still make for a challenging supply-demand fundamentals in the first quarter, which could in turn serve as a headwind to ongoing oil price recovery in oil equities in the short term. However, by the middle of the year, we expect fundamentals to be improving, global oil inventories to be drawing down, and this should support ongoing price recovery in the back half of this year. We expect Brent prices to average at least 55 to 60 in the third quarter of 2021. We also expect refining margins to be on better footing in the second half of this year. Now, the European oils, notably BP, Royal Dutch Shell, and Total, do offer a compelling way to get exposure to the oil price recovery, especially versus their U.S. peers, Exxon and Chevron. And I would note a few key investment considerations. First, valuation. The European oils trade at a very attractive 2021 EV/EBITDA average of about 5 times. That's about a 35% discount to the U.S. average of Exxon and Chevron. Secondly, they provide a very attractive dividend yield. The estimated dividend yield for 2021 on average for those three companies is about 5.2%. And while that does lag the U.S. average of just below 7%, I do believe that dividend yield differential is more than adequately reflected in the discounted valuation multiples for the European oils. Third, the top 3 European oils are estimated to achieve an average post-dividend oil price break-even of about $40 per barrel, that's Brent, versus 50 to 55 for the average this year for Exxon and Chevron, with that lower price break-even reflecting the Europeans' commitment to OPEX and CAPEX discipline. The final differentiating factor I would highlight is the more advanced progress the European oils are making on ESG initiatives. Their strategic plans reflect more careful consideration to a lower energy world in navigating the ongoing energy transition that should play out in the coming years. Now, in terms of more specific stock recommendations, I do expect all 3, BP, Royal Dutch Shell, and Total, to deliver attractive share price returns this year. BP should provide or has the potential to provide more upside given its cheaper valuation and the prospect for debt reduction. Now, a lower risk investment option would be Total. Its valuation is somewhat richer, but it is expected to deliver a dividend yield this year of about 7%, and it does maintain a very strong balance sheet. Thanks for listening.